these are the 6 that we're going to talk about. Hopefully we get through all of them. We're going to describe the nature of a business and the role of accounting and ethics in business. We'll talk a little bit about that, what that all means. We're going to summarize the development of accounting principles. We're also going to state the accounting equation, the basic equation that we'll be using throughout the class. Please know what this is as we get into that. You're going to describe and illustrate how business transactions are recorded, and it will describe the financial statements of the corporation. And then finally, we will go over some ratios and liabilities and stockholders' equity. What leaders look at to see where we are as a company. All right. So the other day we went over what accounting was, and I'm going to go over that again with you in just a second. But this is what a business is. I'll let you guys take a moment to read it. So a business, as you can see, is basically an organization that's providing something. The primary goal of a business is to make a profit. I'll talk about that in just a minute here. So it primarily makes a profit. Most businesses do. Now, obviously, we know that there are nonprofit entities that are out there. And there's quite a few of those. And there's government agencies. But primarily, most businesses are out there to make a profit. And hopefully, they're doing something other things in the local areas to help out, too. But that's the primary goal of the business there. So obviously the difference is for a profit is basically we have more money coming in than is going out. Pretty simple. So we have more money, more revenues than our expenses. And we'll talk about cost of goods sold and all of what that means in a little bit here. Now as you take a look here, you're going to see 3 different types of businesses that are broken down into. So as you can see here, a service business. And there's 3 different ways of accounting for these. And I'm going to tell you a little bit why these are. So you have service business here, merchandising business, and manufacturing businesses. Well, a service business is primarily something, as you can see like Delta Airlines there, they're providing the service to their customers. And so maybe a lawyer can provide the service also. One of the things that they don't have is, and what they have in a merchandising business, is in a merchandising business they have cost of goods sold. Now if you go to, let's say, JCPenney's or a store, they purchase those goods and they're selling it to you. And they marked it up. And so that's where the difference is. And you'll have cost of goods sold in this here. In here, in manufacturing business, there's a lot more that goes into that too. Because now we are developing whatever this is. And so we have direct labor, we have other things that go into that. So there's some differences there, as you can see. So these are some of the examples that you can see as a part of that there. We probably know most of those. Questions so far? You doing all right? All right. So on Wednesday, what I covered is the basic definition of accounting. What is the role of accounting in business? And so I talked to you a little bit about what that is. If you just want to read through it again and review it real quick. But accounting basically gives us information about what is happening with our business. All right. So these are some of the things, the reasons why we do this here. So the accounting provides information to users, such as basically one of the things we want to do is identify the users. Who are we going to provide this for? Because it does matter who we are providing it for. Because the information, we want this information to be able to be used to make decisions, right? Now, if it's for the public, well, we have standards, and we'll get to that in just a little bit here, of what is required as a part of that. But if it's for internal users, we want our managers to be able to use this information to make good decisions to help the business. And so that's what we want to do. So we also want to assess the user's information needs, what they need, define the accounting information system to meet those user needs. So we sometimes need to go out there and find different things that we can use to help the managers. So there may be different accounting software out there. You've probably heard a lot of them. Even just the basic ones like QuickBooks, but there's also a lot of other ones that are out there that can help companies. So we want to record economic data about the business activities and events, kind of like we talked about the definition there, and then we have to prepare accounting reports for the users. So this here is a diagram of what it all looks like kind of coming together. You guys get it there? That's just so slow. Too many of us on it once, I guess. So this is kind of a diagram of how it works there. So we identify the users, and just that flow of information. As a part of that, we continue to do that and assess some of those things there also, because if the managers are not getting what they need, the information they need, then we need to make some adjustments. And some of those are database reports that we are pulling may not be perfect for what we need. So we make those adjustments and create some of those reports or provide other different information for that. All right, so I got a question for you here. On your devices there, you'll see probably an A and a B. A goes to 1, B goes to 2. So just answer your thoughts there on what that is. That is the definition of accounting that we just talked about.
So up is 1?
Right here. Up is true, false is down. That's pretty logged in.
No.
There are a lot of
Is
logic.
it dropping?
Yeah.
Because I've only got 20 showing.
Hmm.
We're supposed to be able to get 100 in here, so.
If you drop out, then you have to start over.
Just start over.
We should have more than
Don't
20
worry, I
now.
won't dock you for that. I'll see that though.
The Wi-Fi is getting pretty hard. But we should have more than 20, Dr. Sutton. You only have 20?
Yeah, that's what mine shows. We got 20 of this. For those of you that are in, go ahead and just answer the question there for me. Those of you that are not, what's that?
It's doing weird, like it's loud in there, but you can't see that.
Huh. I'll let you take it. All right, I'm going to go ahead and slide forward then. If you're not able to get it, that's okay. I have another question here I want you to take a look at. So as you're thinking about some of these things, take a look at the question there. Can accounting help a person evaluate how successful a company like Google is? Answer that question also for me. Green means yes. Yes. Now, obviously, these are pretty simple questions so far. I'll get a little harder ones in just a few minutes.
Will you have the just a regular PowerPoint up?
Yeah, I will have it up to Angel also for you.
Oh, okay, so you can go back and review.
Yes.
Okay.
I will put it out there for you, yep. All right, I'm going to go ahead and move on. All right. So on Wednesday, I talked a little bit about the difference between managerial accounting and financial accounting. I'm going to go over this again on what basically it is. So managerial accounting, like I said, is for internal use and for the companies to evaluate and improve some of the things that they're doing. So that's what primarily managerial accounting is for. That's more in the private accounting. Now financial accounting is a little different. Basically for external users, like I talked about. And we'll talk a little bit about who these external users are in just a minute, and some of the regulations that are put on companies that provide this information out there. So primarily this is to make objective decisions about the business for people that are outside. And so like all of us, like I showed you on Wednesday, you can see all of these things from these companies there, from these publicly traded companies. Now what I'm going to talk about is the role of ethics in business. Obviously, you probably heard of a lot of the issues that have come up in the past about some things with accounting and things that have happened. And they can cost us, as the United States, millions upon millions of dollars when some of these things happen. People lose a lot of their investments. Companies go under because of this. And so those are some things to be aware of. And obviously, it's very, very important. And why there's more regulations on accounting, even more so now, is to provide that, basically that protection a little bit for those people that are taking a look at these external financial statements that we're providing. So we'll talk about what those are in just a minute here, but just be aware of those things there. We'll kind of talk about some of the issues that can happen. These are in the past of some of the things that have happened. Obviously, as you see number 2 there, is Enron. Enron was a big issue that was there, and it was the way that they were accounting for things. They were putting things down that weren't really, hadn't been realized yet. And so there were some issues with that, and obviously there was $60 billion in stock market losses that had happened over that time because of some of the things that happened there. So lots of people had lots of money, in their investments there. They thought it was pretty solid. It was doing very well. And all of a sudden now it's gone. So they may have lost $100,000, $50,000. It caused a lot of economic hardship to not just only the people in the company, but other people. And so that's why there's so many different things. As you can see here, these are just a snapshot of some of the things that have happened in the last 10 to 15 years. So there's more regulations on that. And we'll talk a little bit about that as we go through the class, in that what the regulations are, why they're there, and what the expectations for the businesses are as a part of that. All right, so if you take a look here, just take a look at the slide here, really it comes down to two things. Why ethical issues happen. And the first one, as you can see there, is failure by an individual character. One person creating the problem. And typically, that person is doing that for a reason. It's either for financial gain or to keep their job. I mean, typically, those are the reasons why you do it. The reason to keep their job is because if you don't make money, they're going to fire me. So maybe I'll make some adjustments to what it should be. Or second, maybe it's just the culture of the business of greed. So those are some of the reasons that it can happen. Maybe that's just the culture, and that's what's been set forth by the CEO or the leader of that company. So those are some things that we try to instill. Obviously, we would like to in the CEOs is be a little more ethical and provide the information that should be out there. But sometimes this happens. And now, as you can see, there are penalties for CEOs that do that. We'll talk a little bit about that when we get into SOX, Sarbanes-Oxley, and that stuff, that type of stuff there. All right, so I'll let you take a look here at what this is. So the guidelines, the basic guidelines for the ethical conduct. And so, as a part of that, they have put a lot of consequences in there for people that make those type of decisions. Not only will they lose their job, be fined, they can go to jail. And so those are some of the things that can happen now as a part of that, because of some of the things, especially what happened with Enron. So we'll get to that, like I said, in a little bit here, what it all means and what does SOX do and those type of things. So now I'm going to slide into the opportunities in accounting. So if you did research out there, there's lots of opportunities, lots of jobs in accounting. Even when the times are lean, when we had the past few years, there's still accounting jobs out there. It's great opportunities out there, but I'm going to break it down into different areas. So first is public accounting. Basically, public accounting is for people that do accounting for others. So we hear CPA. Many times, if they're a CPA firm, they're doing accounting for other businesses, people, those type of things there. So they may do taxes, they may just do their bookkeeping and other type of stuff with them also. And then you have private accounting, which is internal. So for a business, even us at ANU, we have internal accountants that handle a lot of our stuff. So, businesses like Ford, Amazon, the ones we saw before, they have internal accountants that handle a lot of that. And they handle a lot of information about the managerial accounting side. And then also you see that for the nonprofits also. And then again, that's a CPA at the bottom down there. You have to have a certain amount of hours. So those of you that are looking at, how many accounting students do we have in there majoring in accounting? Just a few of you? All right, my goal is to double that. Two, so that should be 4, right? You guys want to do it? But there's a lot of opportunity out there. So to be a CPA, one of the things you have to have obviously a bachelor's degree. You have to have completed 150 semester credits to get your CPA, and then you have to pass 4 tests as a part of it. But there's a great opportunity if you do, not just to be an accountant, but to maybe even move up. And a lot of CPAs actually even move up into CFO roles, which handle the financial operations for the company. So there's a lot of opportunity out there. All right, this is kind of a breakdown there. These are the average salaries and type of things there. If you just take a look at it, I'll let you just take a moment to glance at some of those things there. I think this was done in 11. Let's see on there. Well, 2012, excuse me. So this is salary data for that. Now, if you move up into a CFO level, that's obviously a lot more than that. A lot more responsibility too. So as you can see, just starting out, it pays pretty well in the county. All right, I'm going to go on to the next slide here. It's basically just a basic, easy question there. If those of you that are still in, are able to answer that, just go ahead and do so, please, for me. Still only got 20 seconds. Give me a moment here. So how are we doing so far? Is there quite a few of you not in? It looks like. All right. So next thing we're going to talk about here is the development of the accounting principles and relating them to practice. So we're going to go over some of the basic accounting principles here. Now everything is based off here in the United States. For public accounting is generally accepted accounting principles. So that's what you're going to hear a lot, me say a lot, and I'm not going to say all 4 words. I'm just going to call it GAAP. So if you've ever heard of GAAP, this is what this is. And so that's what you will hear me refer to probably quite a bit throughout the class. So know what basically that means. So these are what we follow here. Now the international, they follow something a little different, which is called, they use the Financial Accounting Standards Board, is what is used for that. They're responsible, and theirs are a little bit different. They're more principles based versus ours are standards based. Excuse me, ours is standard. Theirs are principles based. Excuse me, standards based and ours are principles based. All right. Now, one of the things as we see that, what holds these companies to all of this is there's regulations out there. And so for a publicly traded company, they are overviewed, and to be publicly traded like Disney, Coca-Cola, those type of companies, you have a commission called the Securities and Exchange Commission, the SEC, which oversees that. And so they are the ones authorizing your stock to be out there. Without going through the SEC, you can't do that in our country here. So everything goes through them, and that's who you provide your documentation to for your financial statements every quarter and annually. So all those things must go through them. So even if I am the CEO of Disney, if I want to sell my stock, as a part of one of the regulations is, I have to contact the SEC before I sell it, because since I am the president, and I have a lot of influence, I have to let the public know that I am going to be selling these in this time frame here. And so the reason being is if I know we're going to do really bad, if my stock's going to drop, I should be able to and be allowed to dump all the stock and take the money, right? Would that be fair? And so that's the protection that they provide on some of those things there. And so obviously it's gotten more stringent, more stricter as things happen. And so as part of that, and this is for the other countries there, they use the International Accounting Standards Board. Something like that. And what you'll hear me talk about moving forward too, is that you will hear me talk about the convergence that is happening as a part of that. So the international standards are moving towards and converging with our standards here in the United States. One of the reasons is so that way we can value companies the same way. But one issue is that so many companies, so many countries use the international standard. About 100 countries use the international standard, while we only have just us and a few other countries using ours. So they're trying to put those together so we can have and it's been a long, long process. It started back in 1942. So it's now 12, 13 years later. We're supposed to be finished next year, but now it's been pushed back. It's just so many things that they're trying to change and put together. So it's taking some time. So we'll talk about that in class. So now I'm going to talk a little bit about businesses and how they look. So a partnership basically is one person that is running this, and they have all the resources of one person. So I used to run a company like this, and it was just basically me. I was a professional golfer for 8 years, and so that's what I did. And that was just my business. Obviously, there's not much else there. My caddy would be the other person I would have as an employee, but that's about it. And so I ran it as a proprietorship. Now there's other ones that are out there, and you can see that 70% of the businesses are owned this way. Next thing is a partnership. Now that's basically 2 or more people. So 2 or more people, you can set up a partnership. So if one of us were decided to go into business together, we may create partnerships there. So probably a lot of this stuff you may already know. You've had the business class before, maybe you don't. But this is just some basic things there. And this is about 10% of the businesses there, combined with limited liability companies and partnerships. Now, LLCs is been more popular now. One of the reasons is it protects you a little bit. So that's tax and legal liability advantages to owners. One of the things we talked about with proprietorship and partnerships is that it can come back to you. So as a professional golfer, if I decide to hit a waiver ball and hit somebody in the head and they decide to sue me, they can come after all my money that I have. Obviously, I have liability insurance for that, and the insurance I played in had liability insurance also. But if something were like that to happen, they were sue me, then they could come after my personal money. Where in a corporation or an LLC, they can come in after only what is in the company. And that's one of the advantages of that. So you're protected personally. So whatever money you put into the company then can be gone, but they can't come after your house, the car, all of your personal assets. So those are some of the protections that they have. Secondly, if you owe money and your company just starts struggling and you're not able to pay your debts, they can come after you personally again also, if you have an LLC. So questions on that, how that all works? All right. And then the corporations are a lot more. They didn't have a slide on this, so I'm not going to talk about the corporations as much here. But corporations, they make up about 90% of what money comes in that we have here, even though they're a very small percentage, only about 10% of the actual businesses are huge corporations. But they handle most of our money, as you can probably imagine. All right, so what I'm going to go into now is more now towards the accounting part of this here, the cost concept. So these are, if you read here, is under the cost concept, the amounts are initially recorded in the accounting records at their cost or their purchase price. Now remember that. So if I were to go out and buy a house for $100,000, that's what I'm going to record it at. And so if I sell it for $130,000, well, then I made $30,000, right? And so that's what we're going to talk about here. So when I ask you the question, hopefully you'll get that right. So as a part of that cost concept here, if we take a look here, we bought a building here for $150,000. And we'll take a look at the other costs that go along with this. Everybody see that for $150,000? You can move on. So the listed price here was $160,000. That's what they wanted to sell it for. They didn't get that. They got $150,000 of them there. The initial offer here, we offered was $140,000. We settled at $150,000 on February 20th. So this is the estimated selling price here in 2014, and this is the assessed property tax value here. It's $190,000. But what does all that really mean? On the book still, it says we paid $150,000 for it, and that's the cost concept. What did we pay for it? It doesn't matter what it's worth right now in the fact of the cost concept, but what did we buy it for? All right, now the objectivity concept requires that the amount recorded in the accounting records be based on objective evidence. So as a part of that, those are some of the differences there. So the cost concept is what do we pay for it, and that's typically what we do with taxes. We paid for this for it, we sold it for this, what's the difference there? We make money or lose money on that. The objectivity concept is, the fact is, if we are looking at a company, we want to know what they're really worth. I don't want to know that they paid, $100,000 for a building 50 years ago, because I think it's worth probably a little more than that now, right? So I want to know what it really is worth. Taking a look at it, objectively looking at it. So only the finally agreed upon amount is objective enough to be recorded in the accounting records there. All right. So part of this, the next thing we're going to take a look at is the unit of measure, the measure concept. The unit of measure concept requires that economic data be recorded in dollars. For ours here, that's what we typically do. Obviously, other countries may do it with different things. So what I want you to do now is I'm going to give you a question here and take a look at this one here. Read through this, and then those of you that have access to SlideFile, go ahead and put your answer in there. So read through that question. There's not really much calculation there, other than to just take a look and see which one it is. All right, how are we doing? Everybody get that okay? Everybody get that one?
Yeah.
Question? Okay.
We'll keep to the slide and so then we have to.
I'll move on. Hopefully you got that right. For those of you that we moved on from, that was 147,000, except the counter offer on that. So just know that that's the correct answer. The next question here is about the SEC. Just take a look at that, unless you won't answer this question here. Go ahead and move forward here. All right, so we just talked about some basics there, what the different concepts are. Now let's talk about some numbers. Take a look at what this all means, and then also talk about the basic accounting equation. So, the equation here, the resources that are owned by a business are its assets. So anybody give me an asset?
House.
House, good. Anybody else?
Machine.
Vehicle, machinery, those, what's that? Land, yep, those are all assets. So remember those type of things are assets, tangible things that we have. And there's also intangible, we'll talk about that. I'll give you an example of that right now. Coca-Cola, which is probably one of the biggest, they have one of the biggest intangible assets. Just that name Coca-Cola means a lot. If I were to sell Coca-Cola as the company, we have to put a value on how much that name Coca-Cola is. Because we all, you go to just about any country, they know what Coca-Cola is. So there's an intangible asset that's a part of that too. But it's something that it's a resource that is owned by the company. And that's why we call it resource, because it can be intangible, like the name Coca-Cola. Now, liabilities are rights of creditors. So when we take a look at that, somebody mentioned house was one of the first things that they mentioned. We have liability to that house, right? We have a mortgage many times. So that is the liability there. So when you think about liabilities, you'll see it in the book. That's maybe accounts payable. That means we have to pay something out. That's what you'll see it as. And you may have a mortgage note. You may have a notes payable. Those type of things may all be liabilities there. Now, don't think of expenses as that. Something that we owe. And expenses, we've already paid that. So we'll take a look at that. We'll talk about the differences there. It's something that we owe somebody. Just be aware of that. So it's rights of creditors to us. Oh, that's nice. All right. I forget that. All right. Now, stockholders' equity or owner's equity, you see here, that's what you'll see me write it up there in short, is basically the rights that the owner has to those type of things. So if I have this amount of assets, I own this much, well, the rest of that is my capital or owner's equity that I have. And so I'm going to give you an example here in just a minute. And so this is how the accounting equation looks that I have up here. So in math, as we all know, in basic algebra, everything's going to balance, right? An equal sign, both sides have to balance. This is very much the case. Everything must balance. Everything we do must balance in accounting. So we're going to go through a lot of those things here. So the first thing is I'm going to ask you guys a question. So if we have a house, and basically these are the resources here, and I'm going to go through that, and I pay $100,000 for it, and then I owe $80,000 on it. Well, then what do I have as in my equity? So you hear that so much. 20,000, right? So 20,000, and that's basically how it all breaks down. That's simple. So again, if I have a car, a vehicle, that's worth 25,000, I owe 10,000 on it. That means I have 15,000 equity in that, right? And so that's how that equation works. That's simple. So just remember that as you work through that. This is where everything will be, our foundation will be based upon. And this is what we call the balance sheet. That's what the balance sheet will look like. Obviously, there'll be a lot more detail to it, but this is the equation that we'll use throughout the class. That's rights of owners, that's the, rights of creditors like we talked about there. All right, so a quick question, if you guys want to answer that, don't use this here. Which one is this? You put it in your, see if you remember what it is. Now, I gave you, as you're answering this question here, I gave you examples about assets. You guys kind of know what those are, those resources that we have in the company, and liabilities. I didn't really give you a lot in owner's equity. Now, the owner's equity is a lot of times, so when you see for a huge corporation, you'll see something like they may have stock, right? Well, that's the rights the owners have to that, and what their value is on that. So if I'm a stockholder, I want to know how much we have in there as a part of that. Yes, we have so much stock, and we have it's valued at this much. But what does it really mean to me and how much we're making? All right. So I'm going to go to the next question here. I want you guys to take a look at this one, read through it, and figure out what it all is using that equation there. Give you another minute or so, kind of walk through this here. I'm going to put the first part up here so you can see it. All right, so first part there, hopefully you got 450,000, right? Pretty simple there. Now in here it says the assets increased by 150,000, so that went up to 950,000. And then it says our liabilities decreased by 35,000, so I'm taking that away. So now that should be 315,000. And so you should have come up with 635. So it should be number 2 or B.
So what is the owner's equity? I mean, not the equation, but what is that how much they owe? Is that what they
Yeah, how much equity they have in the company there. So if I were the owner, and maybe it's just me, that's how much equity I have in my company.
Oh, how much stock they have?
Yeah, well, yeah, and basically that. So if I close down the company tomorrow, sold my assets for that, paid off my liabilities, that's what I would walk away with. If I were able to get this for that. That's more valuable. Yes. So that's what I would be able to take away with me as the owner. Good question. All right, questions on how that works? All right, so now we're going to walk through some of the transactions and how they all work together here. All right. So as you can see, I'll let you read the definition here. But one thing I will add on to this, and what you read there's a business transaction, obviously there's something that's happened to change our financial condition. But there's gotta be a commitment between both sides. So if you walk into the store and you say, I'm gonna buy that, but have they given you anything for that yet? Or has there been any little transaction that has a real commitment as a part of that happen, then there may not be a actual transaction. So if I walk into the store and say, hey, I want that size large shirt, but I'll be back for it later. Has anything happened there? No, because how many times do people don't come back? They don't. And so there's a lot of times that happens. Now, if they get their credit card and said, hey, and paid for it, and they're going to come back and get it, they made the commitment to pay for it, then I owe that obligation to give it to them, right? And so that's when the transactions happen. So just remember those type of things as you're looking at these. There's the basic definitions there. All right, so the first transaction here is that we're going to walk through basic transactions of what happens as a company is starting up. So this transaction is Chris Clark starts up his company. He takes $25,000 out of his personal account. We are not concerned with his personal account. We don't look at that at all because we're looking at the business side of this. So what happens in here is he has an asset now of cash for $25,000. On the other side of that, he has equity. Because if he pulled out all that cash, that would go back to him as his equity, and it would be zero, whatever, how much he ever pulled out there. So as you can see, once again, this balances, right? This transaction balances. We have $25,000 on each side there. So going on to moving on forward here, you'll see here, now he decides to purchase some land. Now what happens on this one is something a little different. Remember we hit both sides in the first one of the transaction. We hit both sides of the equal side. This time we only stayed on the left side. So the left side here, we just played with assets. We shifted assets. I took my $20,000 cash and bought land with it. So my cash went down to 5, and now I have another asset of land. Make sense so far? All right, transaction C. Now I need to get some supplies. But this time I'm not going to use my cash because I want to hold on to my cash for a little while because I may need it for other things. Pay off my bills or something that may come up. So what I decided to do is use my accounts payable, my commitment to pay. So I walk over to Staples, I buy lots of reams of paper for $1,350. And so I made the commitment to Staples, I will pay you in 30 days. And so that is why it goes under accounts payable. I owe them. So think of pay as I gotta pay somebody. Because it's easy to get receivable and payable a little mixed up. I know when I first went to accounting, I did. So I just want to kind of help you with that. Think of payables, I have to pay somebody, okay? And then supplies is an asset. Why is it an asset? Well, there's paper there. If I don't want to, I can return that paper and then reduce my accounts payable, what I owe, right? So that's why it's an asset. Now, sometimes when we start using that, that's when we'll start figuring out how much of that's supposed to be used. All right. So the next transaction here is created by a purchase on a, I just talks about a little bit about that. And then items such as supplies that will be used in the business in the future are called prepaid expenses. So we prepay an expense. And sometimes we do that for a lot of us. Those of you that drive a car, you probably prepay your insurance, don't you? You pay for 6 months, or they may break it down monthly, you pay ahead of time. Also, when you pay rent at a place, they make you pay for the rent before the month expires, right? So you're paying ahead of time, so it's prepaid. And so that's what it means, we're prepaying expense. But it's still an asset to us, right? Because like I said, I can return that paper. And also, with that, I can, if I decide not to rent anymore, and they let me out of it, they'll pay me back for that, or maybe half the month, or whatever we work out. All right, so during the month here, they spend cash on and use it up, the assets and the earnings revenue. Assets are used in a process of earning revenue and are called expenses. So things happen that we have to expense out, right? We have miscellaneous expenses, we have lots of things that may happen. We may have gas, we have expense, electricity expense, those types of things there. So we're gonna go through some of the expenses here. So here's our expenses here. We have wages, rent, utilities, and miscellaneous. So these are all expenses. They actually go in the owner's equity area. okay? And we'll break this down a little further next week when we dive into it a little more. But for right now, just think of it goes in here. So what we have here, I guess I must have skipped the slide, but we had a fees earned of $7,500. But a part of that is we have expenses that are pulling away from that $7,500. So we're taking away from that. So I'm an attorney, I made $7,500, and now I have to pay out some of my wages, all those things there. And so whatever's left, then increases my stuff over here. And then I also have cash that comes in as a part of that. In my fees earned, it goes away in my expenses. I had to pay all those bills, right? I use something to pay it with. And now the next transaction I'm doing here is now I'm paying, in my accounts payable, I'm paying my credit card bill. This is called my stateless credit card bill. And I paid $950 on it instead of paying the whole thing. So I still owe them $400, but I need to take $950 away from my cash. So you can see here again, everything equals. Everything that we do equals. Now what happens is this. I take a look at my paper. It's called paper where my supplies were. And I find out that I've used up $800 worth of it. So now what I'm going to do is expense that out. Because now my asset has gone down at the end of the month. I don't have that much stuff, right? So I have to decrease my supplies down to $550. So I decrease my paper down to $550. And now I put an expense there and take that away from what I made, because I used all of that to help me make what I made. Because we had lots of legal stuff going on. I had to print out a lot of paper. All right. So now the next thing is now I want to pay a dividend because I need some money to live off of. So I decided to take out $2,000, and I'm paying a dividend. This comes out of my stockholders' equity. But to do that, I lower my stockholders' equity, what I have there. But I also have to pull it from somewhere. What are they going to give me? Well, they're going to give me cash. That's what I'm going to get out of this. So that's why I'm going to reduce cash right here by $2,000. So if we still added everything up, everything still balances. This is how it will look with all those transactions that just happened. As you can see, we went through quite a few, like 8 different transactions there. And these will all still balance as a part of that. Now we have a lot more things that are in there. Now, when I talked to you a little about what we're going to go into on, I said Monday, it should have been Wednesday. We're off. Right here over is your income statements. The income statement, they feed each other. So the income statement feeds into the balance sheet. So we take that information and that feeds in there. So that's what that is. So if you're wondering, well, that looks like income statement stuff. It is. This is kind of how we break you into all this slowly, right? So this is our income, these are revenues, and these are our expenses. That's how your income statement will look. So that feeds into our balance sheet. So hopefully you can see how that all integrates together. All right, the next thing here we have is the retained earnings. And what that basically means is, what are we retaining from what we made? So we had our income statement. I don't know what showed we made. Looks like we have $3,000 there. So as a part of that, we're going to take that information and put that into my balance sheet as part of my retained earnings. That's what we've made and what we will add into our company. Because now we made, let's just say $3,000. We have more, our company's worth more than it was the previous month. Because now we've made some money. So we may have started off the month with $25,000 as we started with, but now we've made $3,000 in our profits, and so it's now it's up a little more. It's about $28,000. All right, let's read through these here. Note some of the following there. again, everything must balance. And here, just know that we don't talk about this in the slide, but if you decrease things by taking money out, withdrawals, or dividends, it decreases the stockholders' equity or capital stock. Forget what that is. We can go through that. Next thing I want you to see here that's what we just talked about with the decrease of the dividends there. Move through that. And then your retained earnings is for those business operations that happen. Those transactions. All right. Now take a look at this equation here, and basically how things work here. Obviously, when they say net income and loss, depending on, hopefully our expenses do not exceed our revenues. That's a bad thing. If we're not making money, we're losing money. All right, obviously, hopefully we have a little more in our stockholders' equity. That's what we want to kind of grow and build as a company. That's something that we look at continuing. Now remember, as I talked Wednesday, I discussed revenues and expenses and what that means, and money coming in. We also have to look at cash flows, and we'll talk a little bit about that later in the chapter, which is on Wednesday. All right, we'll go through a few more slides, and we'll head out. All right, so the financial statements, after transactions have been recorded and summarized, reports are prepared for users. So those things that we are doing there, and these are called financial statements. We are going to talk about 4 different financial statements that we'll discuss. The first one here is that income statement I just taught you a little bit about. So that's those revenues and expenses. That's basically what it is. Income statement should be the easiest one you do. We will actually do a little exercise kind of looking at an income statement on Wednesday. But it's basically for a period of time, a month, year, whatever it is, quarter. That's what we're taking a look at an income statement. So what do we bring in? Revenues. And revenues can be called several different things. Fees earned, sales. It could be called different things depending on the type of company you have. And then you have your expenses, what we paid out as a part of doing that business there, that operations. And so one of the things that we want to do as a part of that, you'll see this quite a bit, is the matching concept. I want to match what money came in with the expenses that go with it. Isn't that fair to do? Because I don't want to maybe front load my expenses or something like that, pay all these expenses early. I want to, if I'm reading this, I want to know how it ties together. Because we can move things around. We can definitely do that. You know, in some businesses, what they'll do is at the end of the year, we did really well. Well, let's just buy tons of our supplies that we need. Do it all early, lower what we made that year, but it doesn't really tie to that. We want to see as much as we can externally how they tie together. So that way we can make a objective thought and opinion about what's going to happen in the future. Because that's what the financial statements are to us, is about where they're going to head towards in the future. Because we are using this information to see what can happen. All right, so that retained earnings statement is the next thing here, which is the period of time, again, a snapshot there, and it's prepared after the income statement. So that income statement is prepared, then we do our retained earnings. And what that retained earnings is, we started with this amount of money, we had this we made, we may have paid this dividends, and this is what we have left. And that's kind of how it works, the basics of that. And we'll take a look at all of these in a little more detail. All of these slides that I'm going through are in chapter 1. So just take a look at, you can see the whole, I'm going right through the chapter as I'm walking through here. And I also have this out there for you. All right, I'm going to go ahead and stop right there for now. I know I've gone over a lot today, a lot to take in. So do me a favor and kind of just review some of those things that we talked about today, and start preparing, get into Disengage now, and start working on some of those problems, just taking a look at those. If you have questions, please come see me. I'm more than happy to help you get Disengage now. Please come see me real soon, so that way you have the weekend